Our next guest says forget about an earnings storm. A mega rally for the market is coming. Let's bring in Steve Chiavarone, portfolio manager at Federated Investors. Steve, welcome to the show. I'm going to start this interview in an unconventional way. I'm going to ask this desk what they think of your prognostication of up 20% for the year. Fun. Show of hands. Who believes the markets will go up 20% this year?
Over what period? Just by the end of the year?
By the end of the year. All right. Steve, you think the markets are going to go up 20% by the end of the year?
I do. And
why?
No offense, but I'm not discouraged. Look,
that's fair.
We just talked about the fact that the market shouldn't be here, right? And that was the idea, right? Banks shouldn't be here. We don't think that the market should have ever been at 2350. At 2350, in our mind, you're pricing in a recession. If you don't have a recession, then we think that there's considerable recovery. And if you go back and you look at the prior non-recessionary pullbacks, 15, 20% pullbacks, you fall on average about 20%. It takes you a couple of months to double bottom, but your 6 and 12-month out returns are quite good. It's 20% over 6 months. It's 30% over 12. We think that at $170 in earnings, the PE multiple can get back to 18 times. That's lower than it was a year ago at this time. And we think $170 in earnings is no more than what the consensus is looking for. We think it's going to take time. There's going to be volatility. Earnings season will be messy. But ultimately, if there's no recession, we think that's where we're headed.
All right. So let me ask you, the market's not a monolith, right?
Yeah.
So do you feel that broadly, or are there specific sectors that you think they're going to lead the way and others are going to be laggards?
I think the Fed changing their tone is a game changer. They were a source of volatility through the entire back half of last year. Powell almost looked like a prisoner when he pulled out his piece of paper to an impromptu question.
Was he blinking?
Said, I'm never going to hike ever again. The most interest rate sensitive parts of the market, cyclicals, small caps, dividend payers, EM, I think all of those can lead. All the stuff that got hammered in December that really took it on the chin, we think that's where you have opportunity. Now, it's scary to buy those right now, but we think that's where the most opportunity lays.
Yeah.
Steve, ultimately, though, when you talk about we're not having a recession, or you don't think we're having a recession, and that's fair. But what if by the third quarter, and I think it's difficult to argue against it being late cycle. We're not going to get 2 consecutive quarters of negative growth, but we certainly, the market could be pricing in recession. And I agree that the market priced banks to recession in December, and we're not there. And by any measure of where banks have been at this stage of the economy. So agree. But I don't believe that by September we can't have a different view of 2020.
Look, it's entirely possible. Here's how we think about it. When you look at the leading indicators of recession, you have credit spreads, you have unemployment claims, what they're doing, you have housing starts. All of those have deteriorated off their best levels, but none of them are anywhere near recessionary levels, and those are leading indicators of recession. If anything, we think as you get to that September part of this year, you're going to have gone through that earnings slowdown where we grow at 5 or 6% a quarter, and you may be seeing an acceleration at the end of that. A recession will come and it'll kill us. We just don't think it's the end of 19, beginning of 20.
But Steve, if we go back and look at 2018, we had an up 7-8% S&P 500 at its highs, and we closed down 7%. It was down more than that at its lows. What are the catalysts in 2019? If we all can agree that we are in a late cycle economy, what are the catalysts for the stock market here in the U.S., especially with the backdrop of slowing economic data in Asia and Europe, and obviously here too? What are the catalysts? I just don't see it.
I think there's a couple. I think one, the Fed being on hold is a big one because the market was pricing in a rate hike a quarter between now and until the end of days. And I don't think that's going to happen. I think we're going to get some certainty on trade. Now, whether or not it's everything we want, we'll see. But at least when there's certainty, companies can start to invest again. And then I think the third thing is because of that weak data, you know, the bulls always are trying to play this game a couple levels out, whereas the data today is usually the fertile ground of the bear. Central banks are not going to lead themselves to the end of the world. Neither are governments. And I think you're going to see stimulus worldwide over the course of this year. You're already starting to see it in China. The fact that we've removed the kind of rate hike cycle here in the U.S., you're going to see that. The idea that Draghi's going to hike this summer, that's insane. Of course he's not. And so I think those will also provide some catalysts over the course of the year. And you were pricing in recession.
I'm going to ask you the same question that Dan wanted to ask Tim. What is more economically sensitive in your view? Is it banks or is it semiconductor stocks? And which sector do you look to?
That's a great question.
If that sector falls, will that give you a clue as to how the rest of the markets will act?
I'm going to try to split the needle on this. I think in terms of pure trading, I think the semis tend to be a little bit more cyclical. However, it's unquestionable that banks are the transition mechanism through the entire economy. I think that's what folks are missing here because there's this belief that if you have a slowdown in housing or if you have a slowdown in the overall market, you're going to have an 08 style collapse. But you don't have the transition mechanism in the banks that you had 10 years ago because they're so darn healthy. And so, yeah, look, all cyclical sectors got hammered. In fact, financials weren't the least of which when you look at Q4 as a whole. Industrials were just as bad, materials, energy. The entire cyclical part of the market got hammered because the market was pricing in a recession. We don't think it's going to happen, and so we think you take the over.
Steve, great to have you. Thanks for coming by. Steve Chiavarone of
Thank you.
Federated. All right, Pete, I will go to you. You did not raise your hand. You did not agree with Steve at first. You heard what Steve had to say.
And
what do you think now?
And I'm generally bullish,
Yeah,
even in the market that we're in right now, and we have a lot of uncertainty out there. But the reason I didn't raise my hand for the 20% I think is a pretty extraordinary move. And I would say if the number was a little bit less, it was something like 10, 15%, maybe I think there's a chance there, because there were pockets that were so overpriced, there's no doubt about it. So when we bring up this PE of the S&P, there are certain areas there that were absolutely extraordinarily high that deserve to be hit. And I think there are areas now that are so inexpensive we can buy them. I think industrials are cheap, financials are cheap. I think those could lead us to the upside. But 20%, I don't think so.
Which areas of the market do you see close to up 20% in 2019, or as close as you can get to 20% up?
I think what Pete just talked about. I mean, it's possible energy, particularly anything that's levered, right? If we get a recovery in energy and there's leverage beneath it, equities could absolutely move 20%. That would probably be one. Some retail, I think, way overdone. I could see up 20.